Hey guys, Matt here. In this video, I'm going to go over something I've been asked about a lot. I'm going to go over the different order types in Fidelity. Just a disclaimer, we'll be talking from these from the perspective of stocks and ETFs. We will not be going over options. So the different order types are market order, limit order, stop loss, stop limit, trailing stop loss, and trailing stop limit. Let's start with the easiest one, the market order. In a market order, and we're going to use Cisco as our guinea pig for now, you will buy or sell an order at the current market price. Simple, right? But one thing you need to know is that from the time you click the mouse, from the time until the time the order executes, time will have passed. And what that means is you're not guaranteed to get this market price. It may execute at a different market price, higher or lower. So maybe that's too risky for you. Maybe you want to have a little more assurance as to, what price you buy or sell a stock. And for that, you will do what's called a limit order. Now, what a limit order will do, a limit order will either buy shares if the market price falls below a specified amount, or it will sell your shares if the market price rises to a certain amount. So let's say I wanted to buy 3 shares of Cisco on a limit order buy. So if I click preview order, and there are different time periods where you can have this limit order last. You can have it last for the entire day, or you can add good till canceled, which will keep the order open all the way until a date you specify. I think Fidelity has a limit of 6 months. But anyways, this order will stay open and will not execute until this market price drops below $49. Likewise, if I wanted to do a limit order sell for, let's say, $49.80, I can do it for day or good till cancel. Those are the most popular options. This order will just sit there and do nothing until either the expiration date or until this price rises above $49.80. If it does rise above that amount, it will then sell the 3 shares. So to visualize a limit order real quick, let's say you put in a limit buy for $48.90 at the beginning of the day. So that limit order will sit there until the price hits $48.90, and then that's when the order will execute. Likewise, if you have a limit sell order for $49.50 and you place it at 9:30, well, the limit order will sit there and do nothing until it hits $49.50, and then it will sell your shares. Now let's talk about all of the stop-based order types. Now, you would almost always use a stop loss or a stop limit or some version of that for selling shares. Now, you could use it for buying shares, but you wouldn't do that unless you were shorting stocks, and I'm gonna leave that outside the scope of this video. So what a stop loss is you would set a stop price which will be lower than this price. So for example, $48, and you can set it for time in force or good to cancel, just like the limit orders. And what will happen is you will execute the stop loss for the time period you specify, and then this order will sit there and do nothing until this price drops to $48 or below. And at that point, the order will sell the number of shares that you specify. So in this case, 3. Now you might be asking yourself, what good would that do? Well, a stop loss is not something that long-term investors do all the time, but it's more for short-term investing. But it's basically regarded as an oh shit method. It's basically to prevent you from losing even more money than you normally would. So, like I said, long-term investors wouldn't be using it that often, but there are situations in which it might be useful. For example, let's say you work nights or you work in a job where you don't have access to your phone during market hours. Going back to this example, let's say you work nights, so you won't be awake during the next day, but you want to sell Cisco tomorrow. You know that tomorrow's your day to sell out. For whatever reason, you want to sell out. What you could do is you could place a limit sell order, because you can do both types. You can place a limit sell order that will sell your shares of Cisco if it hits, let's say, $49.50. Now, you could also put in a stop loss. Let's say you think the market might go down tomorrow for whatever reason. You can put a stop loss that also says, okay, I will also sell my shares if it drops below $48.90. You can put both those orders in at the same time. and whichever condition it meets first, it will execute. Now, a stop limit order combines a stop loss with a limit order. And what that does is, let's say I want to sell 3 shares at a stop price of $49. Now, once it hits $49 on a limit order, it's not going to execute the order. Once it hits $49, it will then look at your limit price, which could be higher or lower. So let's say $48.50. So on a stop limit order, what will happen is the order will sit and do nothing. But if this share price drops to $49, it will then place a limit order to sell your shares at $48.50. Now, a trailing stop loss and a trailing stop limit, I can explain all at once. So with a trailing stop loss, you don't put in a target price. You put in a specific trailing amount, either a dollar amount or a percentage amount. And what that does is, so let's say I have a trailing amount of 20 cents. I got a little graph here. Now, these aren't exactly the stock price. I made these up at a different time. But let's say the trailing amount is 20 cents. You put this trailing order in at 9:30. So what will happen is, as the stock price raises, the trailing stock price will raise with it, staying behind the delta that you choose. So in this case, 20 cents. However, when the stock price falls back down, the trailing stock price does not drop with it. The trailing stop price stays the same. So what this does is it allows you to sell if the stock price drops, but it also accounts for maybe if the share price goes up that day instead of down. So what happens is it keeps going up, share price goes down, so the delta stays the same. And then as the share price climbs back up, so does the trailing price. And then when the trailing price stops back down and it crosses the delta, then you sell. And percentage works just exactly the same way, only instead of a dollar amount, it's a percentage behind. That should be pretty easy for you to understand. And a trailing stop limit follows the exact same logic up until it crosses the threshold. At that point, it becomes a limit order. Apparently on Fidelity, on the trailing stop limit, it doesn't actually let you put in your own limit price like it does with some other brokerages. I looked into some of my own. So the deal with the trailing stop limit, so basically once it evens out to $49.15, that becomes the limit price. You are guaranteed to get $49.15 or better if the trade executes. So basically with a stop loss, so if the price drops from $49.35 all the way down here, whatever price the next one ends up at, it will execute no matter what price it is. Whether it's $49.12, $48, $47, it will execute, but it might execute at a lower price. However, with the trailing stop limit, once it crosses the $49.15 threshold, $49.15 becomes the limit price. So it has to go down and it has to hit it again for the order to execute. So the order may not execute, but you'll be guaranteed, if it does execute it, to get it at least the trailing stop limit. But anyways, let me know if you have any questions. Take care, have a great day, and eat your vegetables.